Please welcome to the stage Laila Maidan from Business Insider and John Koudounis of Calamos Investments.
Thank you for joining us today. We're going to be talking about markets and the economy with John. John, thank you for joining me today. Let's start by telling me about your firm, Calamos. Almost 5 decades of wielding gains for investors. What's very unique about that firm?
Well, thank you for Concordia for having us here today and expressing this. And proud to be part of the Leadership Council and part of Concordia, I think, for the last 13 years. Calamos is an incredible firm, and it has an incredible foundation. Our founder, John Calamos, the firm is based on innovation and risk management. And John was a former Air Force pilot, and he'd always say, you need to figure out what you're going to do before you get in the air, because when you're getting shot at in the air, you better have a plan. And so he's been known to mitigate risk, and he's considered one of the founders of convertible bonds. He's written a couple of books about them several years ago. And so everything we do, of course, we're client-centric. We try to be extremely innovative, and we look at things in a very much of a risk aptitude. So another thing is trying to bring products to retail that they can't usually get. And some of the sophisticated products we could offer mom and pop, where usually professional investors, either big institutions or extremely high net worth people can do. And so we followed that DNA, and to this day, we're continuing to innovate different products where people can have access to, and having access to what some others haven't had in the past is kind of been one of our keys to our success.
So I want to get to that in a bit, but first I want to talk about your firm's strong support of Concordia, the summit, the initiatives there. You're on the Leadership Council. What are the important initiatives, and why is that relationship been so important to your firm?
Well, it's very unique when you can get so many people in government, in business, in healthcare, and all the different areas together to try to discuss solutions. And every day for the last 13 years, there's always been key themes and topics of world events. And being able to discuss things today to try to help in the future has been a great, great, great opportunity for all of us to be able to get together. This morning we had our Leadership Council meeting, and some of the people have been there for a dozen years or so. And then we're adding new people all the time, which is unique. To say that we're solving the world's problems would be obviously overstep, but it's a great place to discuss, to start to think about things, and to come together. People from all over the world. It's a very unique. I don't think there's an organization that does that, and so there's a lot of great things that come from being a member of Concordia.
That intersection where Wall Street meets sustainability, ESG investing. You have a fund, your firm has a fund. Tell me a little bit about that fund and what Wall Street gets wrong about ESG investing.
Sure. Just over a year ago, we launched a fund called the Calamos Investments Sustainable Fund. And so it's a partnership. It's actually a 50-50 JV with Giannis Antetokounmpo, who many of you probably know is arguably the best basketball player in the world right now. And I'm friends with the former owner of the Milwaukee Bucks, Mark Lasry, who is the founder of Avenue Capital. He calls me up one Sunday morning and says, I need your help. And I said, well, what do you need, Mark? And he says, well, my boy Giannis is getting attacked by a lot of people, and they're trying to do stuff with him, and he doesn't understand the markets that well, And they're one of the few people I can trust and could actually literally speak his language. Being of Greek descent, I can, communicate with him as well. Not that his English is actually pretty good, but it's gotten much better too. So I went up to Milwaukee, and the three of us had dinner, and we hit it off. And a very, very special person, besides being a phenomenal world-class athlete. He comes from very humble beginnings, and I saw that we shared a lot of values together. Financial literacy is something that he did not know and was not taught. A lot of us were not taught growing up. He's very respectful of the environment and sustainability. And for instance, his first paycheck, he went to several banks because he thought that the FDIC only approved a certain amount. So the more banks he went to, the more secure his money would be, which in theory is correct. But Mark also told him, you can put it with J.P. Morgan. If that goes under, you have a lot more issues.
Right.
So right around that time when we had the dinner, I had acquired a team in sustainability from Portland, Oregon, that's been doing this for over 25 years. And as we've seen the world change and transform, and back then, about a year and a half, 2 years ago, sustainable or ESG investing was actually the number one inflows in terms of mutual funds and where the money was gone. And we decided, A, we wanted to be in it. B, I think it's really important for us to have an offering in that sector. So I searched the globe over and found this team in Portland, who was the first team to actually do a fossil-free fund. And they had an incredible track record for the last 25 years. They would invest in sustainable securities and beat the S&P. It's hard enough to beat the S&P in trading in any type of securities, let alone in sustainable. So I acquired the team, and I said, you know what? Why don't we do a fund together with Giannis, being that we have shared values in sustainability, and that's how we launched about a year ago.
Speaking about the overall economy now and everything that's going on, the US, we are going into election season. And one of the things I love about the market is it's a free force, it's bipartisan, but the market doesn't like uncertainty. And so we're bracing for some volatility. Futures market is showing a spike in implied volatility. Is that something that investors should be paying attention to? Does what happens in Wall Street in November matter in terms of how Washington ends up? Or are these concerns all unwarranted, and is this just something we're going to have to sit through in terms of volatility?
Well, I think you are 100%. There is going to be volatility. There has been volatility. We've seen a lot of different scenarios. I think the market does react differently depending on the policies of the administration that's in place. But then again, there's both the Congress and the Senate, and a lot of times, if there is a deadlock, sometimes that's actually good because it's more stable than not. But there's no question there's been volatility, and there's going to continue to be volatility. And certain policies of each administration is more favorable for the market than others. And we've seen that in the last several years. And you have what they call the Trump trade. As soon as polls are showing that he might be winning. And then when it looks like he's losing, the markets trade a different way because people think certain policies that they do put in place are going to make a difference, and they do. And the question is, how much can they get through? How much of the tax raises or tax cuts can come through? And each one of those creates a different market scenario. So the volatility is here, and it's our job to try to provide products for our clients that can navigate through these volatile times. And that's something that we pride ourselves in creating products that, once again, our DNA of risk managers come into play, and we try to produce products for people to navigate during these times.
A lot of fund managers are advising clients, for example, don't make any moves ahead of elections or because you're trying to project an outcome, because really nobody knows. And even if one outcome over the other happens, we don't even know if the policy is going to be able to pass, depending on how Congress is divided. Is there any adjustment that an investor could make, maybe not in terms of a sector rotation, but for example, downside protection risk? And is that available to the everyday investor?
Yes, we are coming out with a bunch of products that are actually principal protected. But one thing before we get into it, I think it's really important that people understand that it's very difficult to time markets. And a lot of times people try to pull their money away from the markets when they think they might get volatile or it's going to fall. And what happens is they miss the opportunity. A lot of times you might have a correction in the market, and the next day you get the majority or more back. And so a lot of times you miss that. And there's some statistics out there that leave me now, but sometimes if you're even out of the market for 5 days in a current year, your performance can be 50% less than had you kept your money in all the time. So our suggestions are you keep your money in, but be careful and also start to manage it and add certain products that can help control your risk, which will segue into some products that we've launched this year, is our ETF, structured ETF programs, where we're offering ETFs products that are 100% principal protected on the downside. And what we do is they're benched off certain indices. We have the S&P, the NASDAQ, and then the Russell 2000. So we have a product where if you buy it the day that we launch it and you keep it for a year, we have a cap rate. And through options, we can guarantee a certain cap rate. For instance, the S&Ps right now are in the low 8%. And if you keep it for the year, you will guarantee to get anything up to, let's say, the low 8s. If the market runs to 20%, you're only going to get 8%. But if it goes down 20%, you're not going to lose your money. You're stopped at flat. So in markets like this, where we're having all-time highs in the equity markets, people are questioning, do I put my money there? Well, if you put it just in fixed income to be a lot safer, your returns are going to be a lot lower. And that could also flip on you and lose money too. So this is a very nice defined place where you can participate in some equity upside, but protect yourself from the downside. And we're seeing this product do very, very, very well, especially in these very volatile times.
Yeah, we're seeing a lot of ETFs come to the market that are kind of structured like a hedge fund, which is amazing since we have so many retail investors now that are looking. But also we can't talk about markets and the economy without talking about the big rate cut that we got this month. Finally, the market has been expecting that since March. You've been quite conservative in terms of your projections since the beginning of the year. You had mentioned that you didn't think we were going to get a rate cut until September, and here we are. Is that going to change anything now? We still have $6 trillion in cash sitting in money market funds. We've seen a little bit come out of the sidelines and go into assets and fixed income. How much is this rate cut going to change at this point? And are we behind the curve, or what's your projection here?
Well, we never really want to second guess the Fed, but yes, I think we're behind the 8 ball. I think the whole situation from the beginning was quite interesting. Let's not forget that the inflation was supposedly transitory. Yeah. And then when the Fed chairman got reappointed that same week, it became real. So whether it's political or not, I'm not going to make the call on that, but maybe it was just a coincidence. And then let's fast forward to last week when they lowered rates. Well, I think they should have done it earlier. The rates definitely need to come down. Do I think that 50 basis points was warranted? Typically, a jumbo cut like that is reserved for a time of crisis, or if we definitely think that we're going into a recession. So, or some people might say maybe it was political because they wanted to stimulate the economy before the elections. So I'm not going to go to the political thing, but there's different ways to look at it. Now, if you look at consumer confidence in today's numbers, it's in 3-year low. So it does warrant that rates come down. The situation is not as good as the markets are predicting here.
Right. Yeah.
And a lot of people, the stimulus for just mortgages alone by lowering rates will definitely help the economy. So the rates need to be lowered, whether it was 25 or 50. That's not going to really make the difference. The fact that they need to do it, they should have done it earlier. They're on their way. The amount is a fraction of what they have to do. So 25, 50, not a difference. It's got to go down.
Do you think we're going to get more this year, or is this something that's going to be?
I think we'll get more, yes.
Speaking of financial literacy now, I want to veer back into that because I think it's another really important topic. I've looked at numbers recently that show that almost 50% of U.S. households right now are running out of money in their retirement years. And this includes people that thought that they were prepared, that they invested and they diversified into stocks and bonds. But it's still not enough, because the market is unpredictable sometimes. There's a big mistake that people make, which is when they invest in, let's say, the S&P, they're projecting annualized 10% returns, and they think it's going to look like that until you get to your retirement years and you're withdrawing during a year of a pullback, and you realize that you're not actually as diversified as you thought you were through these two asset classes. Let's talk about what you think people that are investing for retirement, Main Street, what they miss about that, and what some of the biggest mistakes are.
Well, I think it's natural when you're older, you need to be more conservative. And what does that mean? Typically, the more conservative you are, the less yield you're going to get out of your portfolio because the less risk is that you're taking. And so, unfortunately, as you get older, you want to be more weighted typically in fixed income products. And that can go down as well. And the returns on those have, up until a couple of years ago when rates went up, haven't been really good. Let's not forget we were at a zero rate environment for a long time. So that's why actually our products are really doing well, especially these principal protectors, because if you're someone that's retired and you don't want to lose your principal, you don't want to lose your nest egg, you have to have it, right? But you want to participate in some equity upside that you're not going to be able to get in fixed income. That's why some of these products, even the NASDAQ, where you can participate as much as 10%, some of these cap rates have been going of the upside of the market, especially in tech and whatnot, that's been doing pretty well. Those products are actually something that's very good for the retired community because they don't have to gamble on their money. They have the ability to get a lot of the upside of the equities and not worry about looking and losing money in the volatility that's happening right now in the market.
Are these hedge fund style sort of wrapper ETFs, are they suitable for Main Street? And is this sort of a trend that we're going to see more often? And sometimes I look at the way things have been, where if you're accredited, you go to a hedge fund or major investment bank. If you're not, you could access some of these ETFs. Is this structure appropriate for the average investor? And are we going to see a shift in the future where even accredited investors are going to be considering these products over, let's say, the 2 and 20 hedge fund fees that are being charged? I mean, what do you think is the future here?
Well, actually, these products have been available and are available to the really ultra-rich high net worth, and they've always hedged their portfolios this way. And the ETF in the market now, we're able to bring them to mom and pop where they can invest $25 worth and get these products, where before you had to have an entire team who charged a lot of money come into your portfolio to do these structures of options to protect you from the downside and give you some of the upside. So this has been going on for a long time with the accredited investors, and not just for the accredited high net worth individuals, but for sovereign wealth and stuff that would do an options overlay over your entire portfolio. Today, for the first time this year, a lot of these are now available to the retail mom and pop for the first time.
That's great. That's interesting. Guys, thank you so much for joining us today. John, thank you. That's been very great conversation. Thank you, everyone.
Appreciate it.